Welcome to another edition of Focus on Alternatives, sponsored by ADISA. I'm Damon Elder, the publisher of the DIYer.com. Today I'm joined by Michael Fitzpatrick, a partner with Baker Tilly. We're going to be discussing opportunity zones, giving an update on this relatively new investment opportunity that was introduced in 2017 in the Trump tax package. So Michael, thanks for joining us today. Why don't we start out with just a brief overview of the opportunity zones, the benefits, the protocols, etc.
Sure, yeah. The intent of opportunity zones was to stimulate the investment of capital in low-income communities that are underinvested. And this is done through a tax incentive for investors who invest realized capital gains, whether they're real estate related or stock related or virtually from any source, into an opportunity zone fund and hold that investment for a period of time, and there are certain benefits that accrue to them. So the first benefit is if they hold the investment for a period of 5 years, they get a deferral on their original capital gain until 2026. And when that gain is paid, they get a 10% discount on the gain when they pay it. So if they have $1 million gain, make $1 million investment, they report the gain in 2026 at $900,000.
And that gain doesn't include whatever they may have made in the opportunity zone.
No, right. As long as they're continuing to hold the opportunity zone, those gains are unrealized. But when they sell that opportunity zone investment, if they've held it for 10 years or longer, there's no taxation. And what's really critical and misunderstood or not known is there's no recapture of depreciation if it's a real estate investment where they've received real estate deductions or tax depreciation deductions.
So it's a pretty powerful incentive. Again, if you've been holding Apple stock for a number of years, right, sell it and reinvest in an opportunity zone, you really get some tremendous tax benefits.
Yeah, you get a 10% discount on the Apple stock gain, and then on the real estate gain that you reinvest in after you held it for 10 years, there's no taxable event at all, and that can often be equivalent to about 30 to 35% of the capital invested.
Wow, very significant. Okay, so we're 4 years in, at least since opportunity zones were introduced. I know it was a very slow rollout because we were waiting for regulations from the IRS and others. So I think really we started to see projects really start to get going, at least equity inflows in around 2019 or so. How has it been going? I mean, a couple years of actual work, really 4 years since the introduction. How has it been working? What type of equity inflows have we been seeing? You know, what real world impact have we witnessed?
Yeah, I know that our firm expected a significant rush into this space. I can tell you that, you know, certainly we have line of sight to the capital gains our clients report, and you know, and that's only a small part of the country. Sure. And because these tax benefits are so lucrative, we did expect to see a greater amount of capital. I've seen a couple of different varying reports. I've seen 17.5 million as of June 30th of this year, but that would just be the equity investment in the QOF.
Millions or billions?
Billions, excuse me. Yeah, 17.5 billion. But that would just be the equity portion. So those are probably leveraged. So maybe conservatively, if they're 50% leverage, that's 35 billion of investment. But I've also seen numbers as high as 75 billion, which would surprise me.
And we're seeing capital accelerate into these, right? I mean, we're seeing growth, maybe not as rapidly as we expected,
right,
but we are seeing growth, right?
Yeah, we are. And you know, there is one provision that's going to fall off or sunset on December 31st this year. It's that 10% basis adjustment or discount that I mentioned. Investments made in a QOF after December 31st of this year, they can't be held for 5 years by December 31st of 26. So they won't qualify for that 10% basis adjustment. But again, if you dig into the math, and I'm a little bit of an Excel spreadsheet geek and math guy, it's not material to the tax benefit. The real benefit is the 10-year hold. That is significant.
And that doesn't matter. There are no time frames on that. I mean, that goes to like 2046 or something?
2046, I believe, is the right answer, right? So, you know, plenty of time where there's not going to be a rush to sell these assets after they've been held for 10 years. Plenty of time to liquidate in an orderly way or hold it even longer. So
at the end of this year, you're going to lose part of that incentive, but a relatively insignificant amount. It's really the long-term hold.
Absolutely.
Okay. Well, let's talk a little bit more about that, though, with the potential tax increases. Obviously, capital gains, they're targeting. They're even looking at it, getting rid of step-up in basis. What are all the tax implications, and how are they going to impact? I mean, maybe it'll be beneficial for qualified opportunity zones. I don't know.
Yeah.
What are you seeing?
Absolutely. I think some of these things might actually stimulate interest in OZs. An increase in the tax rate would be one of them. So, you know, on first blush, you might say, well, wait a minute. If I can pay my cap gain now at 20% and not defer it until 2026 when the rate might be higher, isn't that a good thing? Right. Well, the fact is that what people forget is Step two. Step two is you hold the OZ investment an additional 5 years to that 10-year holding period, and the capital gain and the depreciation recapture at that point in time, you have to assume it's going to be the same higher rate.
Right.
Is a significantly outweighs sort of the, if the music stopped after 5 years and all you did was pay a higher tax, yeah, it's a bad decision. But you've got to play the long game and hold it for 10 years to get the full benefit, and then it becomes a hedge against rising tax rates.
The hedge is a great incentive.
And then as it relates to the step up in basis and reducing the estate tax exclusion, the step up in basis in OZs is independent from what they're talking about with the step up in basis on death. And so this OZs actually become an incredibly powerful estate planning tool. What would happen is so take, for instance, mom and dad sell an apartment complex, all right? And they've got they've got low tax basis, large capital gain. They're really thinking about the next generation. Instead of keeping that in their estate where it's potentially going to be subject to estate taxes or maybe no step up in basis, they take the gain and they invest it into a qualified opportunity fund. And then that becomes left, and that goes into a grantor trust where it's now an irrevocable trust for their heirs. The step up in basis benefit travels over to the grantor trust with it. So the heirs would then receive that asset as long as the trust held it for 10 years from the date of inception to the date of disposition. The heirs would get the step up in basis. And it reduces the estate tax in the parent's account.
So even if there are, and again, step up in basis is still in the current reconciliation discussion, it's still, that really probably would be an incentive from an estate planner's perspective, really for qualified opportunity zones and funds.
Yeah, you can really get the best of both worlds because you can take taxable assets out of the estate, get them out of the estate tax regime, and then you can still retain a step up in basis where normally that wouldn't be possible, but for an OZ investment. And then probably the triple header on that is if mom and dad are still living in 2026 when the deferred tax is due, they can pay that tax from their taxable estate and further reduce their taxable assets. Okay,
so this program was intended to be temporary. I think a sunset date in 2026. But it seems, and certainly when it passed, it had bipartisan support. As you said, President Biden seems to be in favor, maybe some tweaks around the edges. But it still seems to have bipartisan support. So looking ahead, I mean, 2026 isn't that far off.
Right.
Do we anticipate an extension of this program, perhaps making it permanent? What are you seeing? What are you hearing?
Yeah, great question. So I mentioned a minute ago that we're a large consultant in the new market tax credit area. That program has been living on annual extensions for a long time, sometimes 3-year, sometimes 5-year extensions, which is what it's on right now. I think that just like what New Markets has gone through, OZs will go through an evolution, right? So the types of projects that are being financed today with New Markets, or the ones that were being financed originally, you probably couldn't get done today. They didn't have enough community impact. Today, the program is really hitting on all cylinders with community outcomes. I think OZs will go through a similar type of evolution where they'll tweak it around the edges, they'll kind of get rid of some of the unintended consequences, they'll create a little bit more reporting and accountability for it. I don't think they'll get into like mandating minimum types of outcomes or certain types of outcomes like the New Market program does. I think they'll still let it be a little bit more, let the invisible hand of the economy kind of guide it. Right. But I think they will tweak it around the edges and make some improvements and keep it going.
Okay, great. Another thing we've been hearing is that, given the slow nature of the regulatory rollout by the IRS and, the impact of COVID, particularly in 2020, where there was certainly a bit of a hiccup in cash flow and dollar flows into some of these programs. One of the other things we've been hearing is that they may extend that 10-year deadline from 2026 to 2028. Is that true? Is that something you're hearing or expecting?
Well, so when they actually certified the census tracts for OZ status, they were certified from 2018 to 2028. The magic of 2026 is when the deferred tax benefit expires, and of course 2021, the inability to hold it longer than 5 years. But theoretically, you can make an OZ investment in 2027. You just don't get a tax deferral on your original gain, and you don't get a discount. But you do get that longer-term benefit, which kind of gets into, investors have been too short-term focused, and advisors, for that matter, have been too short-term focused on that initial discount on the original gain. It's immaterial.
Well, I actually, in preparation for this interview, Michael, I was looking at something I think you actually had a hand in at Baker Tilly about the kind of equivalent return you would need from an investment versus the tax benefits that you would receive, along with potential other investment benefits from a qualified opportunity zone investment. Why don't you discuss a little bit there?
Sure, yeah. We published a short paper and created a very simple Excel model that can be downloaded from our website. And what it does is, it's not like I would call it a be-all, end-all decision-making tool, but it will give someone a flavor for, if I have an option, if I have a realized capital gain event and I'm going to make a reinvestment decision, right, because I sold something, I'm not going to put the money under the mattress, so I'm going to reinvest it. If I invest in an opportunity zone and I assume maybe a 10% rate of return, what are my after-tax cash flows for holding it for 10 years? And what are my tax consequences for paying the deferred tax in 2026 at the current rate or even at any rate I choose? So we made it a variable for the investor to look at. Contrasting that with then, it solves for, the Excel model solves for what rate of return would I need in a non-OZ environment to end up with the same after-tax cash flow after 10 years. And what you'll find is, and this kind of proves out the hedging point that we made earlier, what you'll find is a 10% OZ return equates to almost I believe it's about a 15% non-OZ return. So you need almost a 50% higher rate of return in order to get the same after-tax cash flow after 10 years. And if you assume that the cap gain rate goes up, you need something higher, like 16 or 17%. So it really just proves out the fact that it is a hedge.
Really, the benefits from an investment perspective are really still massively significant.
Yeah. And if you're looking at two different, some people want to say, well, 10, 15%. The fact of the matter is, it's a 50% higher return when you go from 10 to 15.
Yeah, you're not talking 5%, you're talking total return.
So really what you're looking at is you're looking at different risk profiles of these two assets, right? I mean, the asset that's going to project a return 10% is clearly going to have a lower risk profile than the one that's projecting 15.
Right. So I think it's probably safe to say that you're bullish on opportunity zone investing and funds and the entire program moving forward?
Yeah, absolutely. I think there's a lot of education to be done, and I'm grateful for the opportunity to talk to you today to help get the word out.
We appreciate your insights for sure and the wisdom, because I think they're still largely misunderstood and certainly not properly understood program. So I think we're going to start seeing a lot more inflows as people do kind of really get educated on this, and potentially, if we do see some tax changes, it'll make it even more attractive. Yeah. So time will tell. Well, again, Michael, thank you for joining us today. Very helpful, very insightful. And thank you for watching. For more information on all things alternative investment, be sure to visit www.adisa.org. Thanks again.